There are two main types of options. On the one side there are call options, and on the other side there are put options. Both of these are linked to an underlying asset. This can be anything. It can be a stock, an ETF, a commodity, or something else. Buyer of a call option has the right to buy the underlying asset at a predetermined price. Therefore, his market assumption is bullish, because ideally he would like to buy the asset for less than it's worth. A put option buyer has the right to sell the underlying asset at a certain predetermined price. Therefore, his market assumption is bearish, because ideally he would like to sell the asset for more than it's worth. And just like with stocks, you can also sell to open or short options. You can either short a call option or short a put option. And they still will be linked to the same underlying asset. But if you choose to short or sell a call option, you won't have the right, but you will have the obligation to deliver the underlying asset to the option buyer at a certain predetermined price if the option buyer wants that. Therefore, your market assumption would be bearish. If the price of the underlying asset would rise, the option buyer would want you to sell him the option for a lower price, thus creating a loss for the option seller. A seller of a put option has the obligation to buy the underlying asset at a predetermined price from the option buyer, if the option buyer chooses to use his right to sell. Logically, the put option seller will want the price of the underlying asset to rise, so that the option buyer won't use his right. The key difference between option buyers and sellers is that buyers have the right and sellers have the obligation. If an option buyer chooses to use his right to buy or sell the underlying security, it is called exercising an option. If he chooses to exercise his option, the seller of that exact option will have to sell or buy the promised shares for the predetermined price. When it comes to exercising, there are two kinds of options: American and European style options. American options can be exercised whenever the option buyer chooses to, but European options can only be exercised on the expiration date, but more on the expiration date later. But note that exercising is not the same as buying or selling an option. Both the option buyer and the seller can still buy or sell their options whenever they want to. Now let's get into the expiration date. Different than stocks, options have no unlimited runtime. They expire. If the company never goes under, stocks could theoretically be held for an unlimited amount of time. But if options aren't profitable within a given time frame, they expire worthless. Options can span over different time frames. Some options expire weekly, some expire monthly, and some even expire yearly. For each of these time frames, there are different expiration cycles. Strike prices. Probably one of the most important aspects of options. The strike price of an option is the certain predetermined price that I mentioned so often earlier. Let's start with the strike prices for call options. In our example, the underlying stock is trading for $100. If the strike price of our call option is below the current trading price of the underlying, so below $100, it is considered in the money, or ITM. And if the strike price is the current trading price, or at least is very close to it, it's an at the money option, or ATM. And finally, if the strike price is above the underlying trading price, it's considered an out of the money option, or OTM. And for put options, it's just the other way around, because a put option profits from a drop in the price and not from a rise. Now let's sum things up with two examples. For our example, we use stock XYZ as the underlying security. XYZ is trading at $75. Our first option will be the July 17th call 80. This means that this option expires on the 17th of July, has a strike price of 80 and thus is out of the money. For this option to be profitable, it has to become an in-the-money option. And for that to happen, the price of XYZ has to rise above $80 before the 17th of July. So the market assumption is clearly bullish. Our next option is the October 17th put 80. This means that this option is a put option that expires the 17th of October and has again a strike price of 80. But this time the option is in the money. So theoretically it already is profitable. But if this option already is in the money when you buy it, you will have to pay more for it. So the October 17th put 80 will first be profitable if the underlying price drops under 75. Therefore the market assumption is bearish. To keep track of all this, there's something called an option chain. An option chain is a table displaying all the available options and all their relevant information. Here you can see an option chain from Nasdaq. The underlying is Apple and it's trading for around $143. Every row is a new option. On the top you can see the different expiration dates. And in the middle column, next to the ticker symbol AAPL for Apple, you can see the different strike prices for these options. The calls are on the left hand side and the puts are on the right hand side. The options with the yellow background are the in the money options, and the ones with the white background are out of the money. The color shift in the middle is where the at the money options are. Additionally, much more information is displayed on an option chain. Information like the bid-ask prices, volume, open interest and much more. But more on that in a later lesson. For now I wanted to say thanks for watching, and to learn more about option trading, visit tradeoptionswithme.com.